Back in 2022, the Nobel Prize in Economics went to an idea that peels back the curtain on this incredible but kind of dangerous magic trick that sits at the very heart of our financial system. It's a trick that literally makes our modern economy possible, but it also makes it unbelievably fragile. So let's pull back that curtain together and see exactly how it works.
And this really gets us to the central question we're going to tackle. I mean, think about it. We're always told that banks are the bedrock of the economy, right? But then we see them collapse in these super dramatic ways. So how can they be both things at once, absolutely essential and terrifyingly fragile? Well, the work of Nobel laureates Douglas Diamond and Philip Dybvig gives us the key.
Okay, so to get why we even have banks in the first place, we have to start with this fundamental conflict, a problem that exists in any economy, whether banks are around or not. At the core of it all, you've got this basic clash of interests. On one side, you have savers. That's people like you and me. We want our money to be safe, sure, but we also want to be able to get it out right away if we need it. Economists have a term for this, high liquidity. But on the other side, you've got borrowers. Think of a business trying to build a new factory or a family wanting to buy a home. They need money for the long haul, and they definitely can't pay it all back tomorrow. They need low liquidity. See the problem? These two desires are completely at odds with each other. This quote just nails the problem perfectly. Can you imagine, without some way to bridge this gap, all our money would be locked up in things we can't easily spend? The whole economy would just grind to a halt. You can't buy a carton of milk with a bathroom tile. You need cash. So what's the solution?
And this is where the bank steps in. It performs this really clever and honestly socially valuable service.
Now, the fancy term for this magic trick is maturity transformation. It sounds super complicated, I know, but the idea is actually beautiful in its simplicity. Banks take our short-term liquid deposits, the money we can pull out anytime, and they bundle it all together to create the long-term illiquid loans that borrowers need. They're basically transforming time. It's financial alchemy. And you can see that whole process right here. All this money flows from tons of individual savers, like us, and it pools together inside the bank. The bank then acts as this middleman, this intermediary, funneling all that money into big, productive things. Factories, roads, houses. It totally solves that fundamental mismatch we were just talking about. So here's the key takeaway. This isn't just about banks making a profit. By doing this maturity transformation thing, they're creating the liquidity, the cash flow, that allows the entire economy to run smoothly. They finance the huge projects that drive real growth. It is an absolutely vital function. But, and this is a huge but, here's the twist. The very thing that makes banks so incredibly valuable also contains the seeds of their own destruction. And this right here is the core paradox of the Diamond-Dybvig model. See, the very act of turning short-term deposits into long-term loans means the bank never has enough cash sitting in the vault to pay back all of its depositors at the same time. This creates what you might call an inherent fragility. And that built-in fragility is what leads directly to the terrifying logic of a bank run. It's this devastating chain reaction. It all starts with a little spark, a rumor, maybe true, maybe false, it doesn't even matter. That rumor makes you worry. But here's the thing. You're not worried that the bank is actually broke. You're worried that other people think it's broke and will start pulling their money out. And since it's first come, first served, the only rational thing for you to do is get your money out first. Well, when everyone thinks that way, the rumor becomes a self-fulfilling prophecy, and the bank collapses. And that is the mind-blowing insight that won the Nobel Prize. A bank run isn't just a bunch of people panicking irrationally. No, it's the completely logical outcome of a bunch of individuals each making a perfectly rational choice based on what they expect everyone else to do. It's a coordination game you literally can't afford to lose, and it's a flaw that's baked right into the DNA of banking itself. So if this weakness is just hardwired into the system, what do? How do we protect ourselves? Well, the model doesn't just point out the problem, it also points us directly to the solution. The number one tool is deposit insurance. And it's a simple but unbelievably powerful idea. It's a credible promise from the government saying, don't worry, your money is safe, no matter what happens to your bank. So how does this actually work? How does it break that cycle of fear? It's simple, really. It completely removes your incentive to run to the bank. If you know for a fact that your money is guaranteed by the government, you just don't care if your neighbor is pulling their money out. The fear is gone. This simple, believable promise short-circuits the whole bad equilibrium of a bank run and stops a panic dead in its tracks, usually before it even begins.
You see, this elegant way of explaining both the problem and the solution is what makes this research so groundbreaking and just so important for every single one of us.
And it was for creating this powerful and elegant model that Douglas Diamond and Philip Dybvig, along with Ben Bernanke, were awarded the highest honor in economics. And look, their model isn't just some abstract academic theory. It provides the actual theoretical foundation for the deposit insurance systems that protect all of our savings today. It's the intellectual bedrock for how we regulate banks and manage financial crises. It fundamentally changed the game. But all of this leaves us with one last, pretty critical question. The Diamond-Dybvig model gave us the playbook for taming the risks in traditional banks. But what about all the shadow banks out there? The money market funds, the investment firms, all the institutions that are basically performing that same dangerous magic trick, but without the safety net of deposit insurance. The ultimate lesson of this Nobel-winning idea is that the risk, it never truly goes away. The question is, can we spot it before the next panic begins?